Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and there was recently a request to take a look at some gold stocks, specifically small cap gold. So today we're going to take a look at one I personally own. It might not be small cap, it's mid cap, but it'll give us a good starting point so we can do some head to heads on some gold companies. Because, I mean, if you look at the price of gold, it's up at almost an all time high. It peaked earlier this month and has come down a little bit. But typically, in times of uncertainty, you see a pretty steep rise in that price of gold. Some people believe that it's the only true money, and that's where you should put your cash because, at least at one point in time, it was the true money. Your dollar would just be exchanged for gold that was held in a vault, and you just had a coupon for that gold. But as you see, gold price is very high. Not sure how it's going to continue from here. It definitely ran up in 2020, flattened out, and it's pushing up again right now. So we'll take a look at one of the stocks that I own, Barrick Gold Corporation, ticker GOLD. They own multiple gold mines around the world, and they pay a pretty decent dividend. So at least you're getting exposure to gold, but also getting a dividend at the same time. It looks a little strange here because they are very undervalued. And since they operate gold mines, that's what the true business is. The commodity itself can play into it, but they're the ones that are mining and selling the gold. So we're looking at a fair value here of just north of $23 with the stock currently trading of 1563. Cash flows clearly aren't the best. Just kind of cash flow of 1166. Looks like in the past they've had decent cash flows and they're down right now, and that's probably part of the reason why the share price. The low that we would want to get in is pretty close to where the stock currently sits, within 60 cents. So I'd say it's a reasonable time to get in if you believe that it has the ability to achieve this fair value and it's not a company that's on the decline. The earnings yield could be better. It's not bad, but it could be better. Cash flow yield, it's been good in the past. Currently, it's not the best. Dividend yield does look pretty good, 2.56%, average of 1.93. So that tells you right there that it's undervalued. It's fetching a greater yield than investors typically look for from it. So they might have gone to bonds or something else that's paying a higher yield at the moment, and they might be coming back when interest rates start getting cut. Payout ratio, 55%, a little high, but right about where we like to see it. 30 to 50% is a good payout ratio. ROE, ROI, and ROA are all honestly pretty low. 5.5, 3.2, 2.75. These are not good numbers. We'd want to see something more in line with market returns, 7 to 10%. So that way we know that the cash that we're giving the company is able to fetch a return in line with the markets. Now, the balance sheet doesn't seem too bad, 0.58 debt to equity. They could reasonably handle another $9.5 billion of debt. Margins, 30% gross is pretty good. They've been as high as 36 on average. And net, 11%, 12 on average. Those are pretty good too. I like to see companies where gross is 30, net is 10. That's what I feel like is a fair, almost minimum that I look for in a company. So we see that revenue has been declining, but analysts are projecting going forward for the next 2 years, it's going to start going back up at decent rates too, 7 and 8%. So we're going to go with 7.5 for our thesis here. Share count, they're pretty good at buying back shares by about 0.5% a year. So we are going to assume that they continue on that, buying back 0.45% of outstanding shares. Cash flows. Now you may be looking over here and seeing that it's negative on the 3-year and 2-year compound annual growth rate. Why are we putting 9% over here for the cash flow growth? Well, over the course of 5 years, if their revenue is growing at 7.6% and their cash flows are growing at 9%, they end up with a cash flow yield of 3.5%. They currently have a yield of 5.7. So this, I'd hope, would be an underestimate where they're able to get yields more in line with what we've seen previously. And at that point, you'd be looking at something much greater than this, something more along the lines of 20%. 20% would get you more in line with what we see today. And with that, you're getting much better annual returns. That's something that my personal thesis would be, at least to hold the current cash flow yield, because looking at these cash flows, 26.7, 16.2, almost 4, 5.7. So they were up from 2022 to 2023. This 3.1% is being calculated essentially off of expected revenues and then continuation of the trend in their cash flow. So even if they continue to drop at that 30 to 40% rate that they have been dropping, then they'd be left with 3.1%. That's why I'm thinking 9 at a minimum, 20 would be ideal, and to get back up to double digits would be incredible. 35% at that point, compound annual growth rate for the cash flows, get them back up to 10.2 in a 5-year time frame. So that does not seem unreasonable. I mean, if it's able to drop 30, 40% per year, it can jump just as quickly. And that would give good returns. 6% average return. Once you factor in dividends, you're looking at 8.5% per year. So that'd be more of a bull case for the stock, and that would put it on our list to monitor and see where the price sits every single month. Dividend, their payout ratio is getting a little high, and they haven't risen their dividend in quite some time. They typically pay out 10 cents per quarter, and there was a bit of a spike where they paid out 15 cents for a single quarter back in 2022. So the continuation of 40 cents would be a safer estimate. They can afford it as long as they are able to keep their earnings where they stand. With that growth rate that we see in the revenue, we'd hope that the earnings would at least increase. So again, this would be safe case, flat, reasonable case. I don't think it'd be unreasonable to say that they would be capable of getting the dividend back to 45 cents in a single year. They did it back in 2022. Based on everything else here, it definitely would be reasonable. So that would give you a yield on cost buying today of 2.9%, which is pretty good. I prefer something 3.5 and above, but 2.9 isn't awful. And then margins, they were a little low in their margins this last year. Average is 12%. So if over the course of the next 5 years they're able to get up to 12.02, that's lower. That's almost in between their average and this last year's performance. 1.5% a year. It's not unreasonable. So what we'll be looking at here is in 3 years, the share price would be $30.40. So between appreciation and dividends, you'd be looking at a total profit over the 3 years of $16 per share for a gain of 103%. At the same time, SPY would be looking at doing about 26% on average. And over the next 5 years, you'd be tacking on another almost $5 to that, where you'd be sitting on $21.5 in profit, outperforming the market by 90%. So now the question that you need to ask is this reasonable? Would you come up with a similar thesis? Well, we looked at the price of gold right now, and it is sky high. So if they're mining and selling gold at the moment, their margins are going to be better than they have been. If we look at the last peak about a year ago, their margins from November of last year onward are the best margins that they have ever had, which will help to drive the revenue, the margins, the cash flows, everything. So this could be, so at the current price, to me, it seems like a reasonable risk to take, assuming that the stock is lagging the commodity in which it trades. And later in the year, as the Fed begins to cut rates, if the markets react poorly to that. Something like gold will likely see a good boost, and especially something with higher yields. Now, the average yield in the S&P is about 2%, so 2.5% isn't anything crazy, but the combination of factors could potentially drive this stock up to its fair value and maybe even beyond if it has enough momentum. That's what I'm thinking about this one and what I'm seeing. Let me know what you guys think down below. Like if you enjoyed the video, and subscribe so you can stay up to date, because I'll put this in as our case for the stock, and we'll continue to follow it and see how things go. It is a stock that I own. As I've said, I've traded gold as it's hit new all-time highs. I've made small call credit spreads to try and capitalize on that. And all of that profit, I'm just rolling straight into Barrick Gold. So at least I can have some exposure to that market and collect a dividend along the way. So I'll keep digging into different gold companies and see what else we can find, do some head-to-heads, and keep an eye out for those.